Hello everyone, today I want to talk to you about a massive figure in the investing world, a super investor that has been coined as being the British Warren Buffett, and that man is Mr. Terry Smith. Now Terry Smith is an excellent investor that manages over $25 billion with the hedge fund Fundsmith LPP based in London. Now he's primarily a value investor that is similar to Warren Buffett in how he looks for stocks. He looks for high quality companies that in his own words could be run by an idiot. In fact, he has talked about in great detail 10 golden rules for investing for individual investors, and we're going to be going through them today. And he sticks to those to get amazing returns, so hopefully we'll be able to as well. So in this video I'll be going through those 10 golden rules, I'll be sharing my thoughts on them and how they may apply to my current portfolio that I hold on Trading 212. And if you get something out of this video, then don't forget to like it and of course subscribe for future content so you don't miss out on anything. Let's jump straight in with the first golden rule. That is, if you don't fully understand it, then don't invest in it. Now, this one makes sense, but Terry Smith talks about it in a bit more detail. He's maintained that mere investing for the sake of investing will always eventually result in losses. Therefore, he stops himself from investing in funds, stocks, or even structured products that he doesn't really understand. Now, to me, this one makes very good sense, and I'm sure it does to you as well. But actually, how much do I understand a certain company, and to what extent? So, do I use it every day? I use my iPhone every day, and order packages from Amazon very regularly, almost every day, unfortunately. Then there's Google. I search on Google all the time. So, these stocks I use every day. But do I have an understanding of them? How do they make money? My largest holding, for example, Amazon, and I believe I've done enough research into this one to actually show how they make money, their growing aspects of the business, and parts of their business that aren't maybe doing as well, like their physical stores. So essentially, their growth aspects and the areas that I believe aren't necessarily growing that well are well known to me. However, there is one stock in my portfolio that I've talked about not really knowing enough about. That one is United Health Group. And I've talked about this one a bit, but I don't use it regularly. I don't have an understanding of it from the past or even now. I don't live in the US and I don't use their healthcare system. So for me to fully invest in this US healthcare stock, I should maybe have a better understanding of the healthcare system. So maybe that's what Terry Smith is alluding to with this first rule. Then we have the second rule. Don't try to time the market. Now this one is obviously the idea of getting into a stock at all-time lows and getting out somewhere near the highs. But we can't know the highs and lows. No one does, and no one can predict the market. So Terry believes people hate the feeling of selling when everyone else is buying, and it makes us feel alone when we try to do so. So that's the one thing he tries to avoid. So don't try and time the market and buy when everyone's buying and sell when everyone's selling. Don't follow the herd. Have your own idea. Then we've got minimising fees where possible. Now Terry points out that the average UK investor that invests via an advisor and uses a platform, they usually invest in mutual funds, incurring around 3% in charges per year, which is equal to around a high interest savings account if you wanted to go down the route of interest. And that's compounding over time as your returns compound, effectively drawing and draining away money that you have necessarily maybe earned. So what he's actually talking about here is cut down on the charges that will be hitting your portfolio. Don't invest in 20 funds when one will be good enough. And invest in the lowest possible charges so that you don't drain your portfolio as the years go on. Fourth on the list is to deal as infrequently as possible. So effectively we want to trade, sell and buy our stocks as few times as possible to actually make better gains. Now this one makes sense because effectively you always get some sort of fee when you buy or sell stocks. Depending on your platform, you may get commission, stamp duty, FX fees. Just the other day when I bought some more Visa stocks, I got a higher FX fee amount for the amount that I was trading. So they're taking away my money, and effectively they're doing this every time that I buy or sell stocks. So in essence, every time we buy or sell stocks, we are allowing someone to charge us money and to weigh our portfolio down by the fees that they impose. So maybe we should ask ourselves before making those trades whether they are strictly necessary. And then we've got the fifth on the list, and this one's pretty a big one for me. Don't over diversify. So Terry explains that while a portfolio diversification can improve your investment performance, it does have some drawbacks. So research suggests that 90% of diversification benefits can be obtained in most markets when a portfolio has just over 20 stocks. Any more than that, and the less you know about each individual company and your investments. So for me, I wanted to have control over what I invest in. That's why I invest in individual stocks. So I don't think he's talking about index funds here. I think he's referring to owning maybe 50 investments and knowing what maybe half of them do. So effectively, I'm keeping my stocks below 10 for this exact reason. I don't want to go above that because I can't keep up with the earnings reports and regular news that these stocks mean that I have to look into. Then we've got the next one, which is never invest just to avoid tax. Now he specifically talks about funds, sort of enterprise investment schemes for this one that aims to avoid or defer tax payments, and remarks that investors often ignore the massive fees and poor performance of the underlying investments that these schemes offer. So effectively, it's often more cheaper and a better option just to pay your tax. Seventh rule is to never invest in poor quality companies. Good companies reinvest to grow their business and compound the value of the company as a whole. This is in the form of return on investment capital that is offered to shareholders through share buybacks and dividends and research and development to grow the company organically. And then we've got the bad companies, and effectively they do the opposite. And if you invest in a company because you believe the management will change or their results will pick up with economics or changing market environments or business cycles, then you may be losing value over time whilst you wait. With good businesses, time is actually on your side. So Terry Smith believes it's a good idea to maybe hold on to the good investments for lengths of time and the bad investments for less time. This is what I want from my portfolio. I invest in Visa, for example, because I like the way they are run and I want to own them for the next 10 years. I don't hope that things will change with the company, the management, or even the market environment. I just want them to carry on performing how they have historically done and continue to operate in the same way. In fact, all the companies I own, apart from Amazon and Vici, are buying back their shares, and in lots of cases are offering over double-digit growth in terms of dividends. And in Amazon's case, they've heavily reinvested back into the company over the years, reinvesting about 85 billion back into the company from the start of 2024. That is improving their network, Amazon's cloud service AWS, and working to push up their revenues in the future. All these things I want as a shareholder. The next rule we've already mentioned, which is to buy shares in a business that could be run by an idiot. Now, I don't believe he's calling Satya Nadella, the CEO of Microsoft, an idiot, because he has over 12% of his portfolio in the stock. I think this is more surrounding don't invest in one amazing person or a CEO because one day effectively they won't be there. And if someone else can't do what they did with that company, then your investment may suffer as a result. Now, second to last is don't engage in the greater fool theory, which is the social phenomenon when you are relying on someone to make the same mistake/decision that you did. Therefore, you should only buy a stock because you want to own it at the right price. If you buy any investment with the sole intention of selling it on, or you overpay even for a good company, then you are relying on the greater fool theory. The success of this strategy is that someone else will be willing to play the same game as you and buy the company at higher and higher valuations. When I apply this to my own stocks, I don't hold them with the intention of selling them, but I will do that if their fundamentals change. I held United Health Group when they had multiple bad stories, and the stock dropped over 20%. When they had an antitrust violation and a number of other things. And I still hold Salesforce for the similar reasons that I continue to hold United Health Group, in what I would describe as an unjustifiable sell-off after earnings. I've tried to value these companies, and in no case if I had done that, and if they didn't meet my value thesis, I generally just wouldn't buy the stock to begin with. Finally, probably the best one on the list, and one that I'm definitely guilty of: if you don't like what's happening to your shares, switch off the screen. The prices of shares varies, and that can have nothing to do with the fundamentals of the business itself. So the movements in the share price will not necessarily mean that it's a guide to whether your investment was a good or a bad one. And if you don't like seeing it, just switch it off. Now, I'm definitely guilty of looking at stocks almost every day, and I imagine a lot of people are as well. Now, I've got better at not letting it affect my financial decisions and whether to make investment choices like buying or selling, but I would be questioning every one of my investments when I first started out. So in the future, I actually hope to cut down on this and maybe look at share prices and as they go up and down throughout the week a little bit less. So that's about it, guys. When I consider all of these rules, I think they are really beneficial to individual investors like me, and will definitely be bearing them in mind in the future when it comes to investing. But how about you guys? Do you like these rules? Are there any you've actually broken, just like me? Then let me know in the comments down below. And as always, thank you very much for watching. I do appreciate it, and I will see you in the next one.